Good morning and welcome. Welcome to our seminar. My name is Jonathan Schein. I'm the Global Head of Business Development for Institutional Real Estate, Inc. And this morning we are, and absolutely this afternoon for those in Europe, and then again morning and for those in Asia, we are featuring a webinar sponsored by our friends at Nuveen, Real Estate Alternatives 101, Preparing for the Next Decade of Real Estate Investment. It's a very exciting webinar. We have more than 400 people registered, and we hope you enjoy the next hour. Our illustrious panel includes Manny Casanga, Director for Real Estate and Real Asset Investments, New York State Common Retirement Fund, Taylor Mammon, Senior Director, RCLCO, Michael Hunter, Global Head of Alternatives and Strategic Transactions, and finally, Melissa Reagan, Head of Research, America's Nuveen Real Estate. Melissa is going to set the table for us and go through a series of slides on her research as she does head up research. We also encourage you to ask questions throughout the webinar so we can make it more interactive and more fulfilling for you. So with that, Melissa, the table is yours.
Great, thank you, Jonathan. So just sort of starting here on this slide, really going to talk today about kind of three broad categories that of the alternative property types: healthcare, housing, technology. Within healthcare, we really think about that as life science, medical office, senior housing. And within housing, single family rentals, manufactured homes, self-storage, and within technology, sort of data centers. So really to sort of set the stage, those will be the kind of focus of our comments around the alternative property types today. You know, at a very, very high level, when you think about why is this compelling, or why are these sort of compelling, you know, property types to be in? When we think about healthcare, it's one of the fastest growing sectors of the economy. It now accounts for nearly 1/5 of gross domestic product here in the US. We really think healthcare centric real estate, particularly medical offices, life science, is going to continue to grow, particularly in a post-COVID world. We do think, you know, COVID has certainly sparked, you know, more research into vaccines that'll drive demand for things like life sciences. And we also, in our view, there will be a huge shift to more outpatient medical office in a post-COVID world. People are a little bit more reluctant to go into a hospital, and also just it is just much cheaper to have the delivery of care in an outpatient setting. Moving into housing really quickly, the demographics here, I'm going to concentrate most of my comments here on single family rentals, as well as senior housing. Senior housing, you know, kind of can straddle either healthcare or housing, sort of depending on how you look at it. But the demographics here are pretty undeniable. So if you think about, you know, what really drove the apartment demand wave here in the last decade, it was millennials. And what's going to drive it in the next decade is millennials. But millennials are aging, and the oldest one is now 39. They're 22 to 39 in the year 2020. There's 80 million of them. And these older millennials are they're starting to get married, they're starting to have children. And so typical multifamily units are just not big enough for them. Most multifamily units have kind of 1 to 2 bedrooms, and they really need 3 to 4, which is what the single family rentals can really offer. So we see a huge kind of demand wave behind the single family rental market. Self-storage, interestingly enough, as millennials are going to have to move likely out of their apartments, that will actually generate demand for self-storage. One of the reasons why you lease a cellar unit, typically a vent. And manufactured homes are really more of a growing trend around just sort of affordability in housing, and sort of that lack of affordability that is really you know, needed. In terms of technology, we'll focus most of our comments here on data centers. They've done incredibly well throughout COVID, with prices actually rising. A lot of that is due to growth of global internet traffic, mobile-to-mobile connections, Internet of Things, sort of just anything the next gen, right, of innovation does drive a lot of demand for data centers. There's many different types of data centers, which we're not going to go into all the details on that, but we do feel pretty strongly that this is another you know, really strong growing sector from an alternatives standpoint. So moving really quickly, I don't want to take up too much more time here to set the stage. No one's going to be surprised by this chart on the left, right? That shows alternatives have outperformed in the last 5 years. You're all here because you're probably interested in alternatives and you're probably well aware of this fact. But the question I get an awful lot is, okay, when you look at the chart on the right, well, Melissa, but outperformance historically doesn't mean anything about the future. And how can you be so confident there will be outperformance in alts going forward? Michael and I have talked about this a lot, and I think there's two things. So first of all, they're all the tailwinds I just laid out in the previous slide. They're undeniable. They're strong. They're going to continue to generate those returns. I think the other factor, which you're going to hear a lot about today, is there's a lot of these sectors are still really fragmented, and there is an opportunity to sort of aggregate up some of these sectors, and when you have that aggregation, you can really generate a premium for that. So I think those are the two things I really focus on when I think about that sort of continued outperformance. This slide I really like. It's almost labeled incorrectly. I like this slide because it's not really about diversification. It's really about trying to create a sense of urgency around allocating to these alternative property types. And by that, I mean, everyone is institutional investors. You're all very familiar with this chart on the right, the Odyssey chart, with the allocations right to the 4 traditional property types. And alternatives comprises sort of about 12% of a, just sort of on average, right? But there's a problem, right, in that you're all aware of, is that office and retail are increasingly uncertain. That leaves you with apartments and industrial. So your hand's almost sort of forced, right, into thinking beyond just these 4 property types here in Odyssey land. And that really gets us to the chart on the right. And when we really think about where institutional real estate investing is going, it's more along the lines of a 50% in a decade from now, more along the lines of 50% allocation to these alternative property types in sort of a decade from now. You may say that's a huge shift. I really don't think so. I think, again, the way we've sort of thought about it and constructed it, there's a lot of opportunity out there in the alternatives and a lot of ways to access these various alternative property types. Of course, in that chart, certainly some of the traditional property types, retail, office, industrial, they're going to play a role. They're not going anywhere. But I do think in the next decade, there will be a continued push to these alternative property types. So I'll leave my comments there and I will turn it back to Jonathan.
That's terrific, and thank you, Melissa. I'd like to start off with our investors and our consultants, and I'd like to bring it to Manny. Manny, what is your current allocation to alternatives, and what do you think about its role in your portfolio? And then I'm going to move over to Taylor and ask to him about his clientele. So, Manny?
Morning, Jonathan. Thank you. Hope everyone is doing well. So currently, the allocation at the New York Common Retirement Fund is about 7.5% of our total AUM today, and it's predominantly self-storage. We've been an investor in self-storage for a good past 15 years, more or less. So it's a good investment for us. Stable cash yield with low capex. But in regards to the overall role for the portfolio, it's a diversifier. That's what we want it to be for against the 4 main property types. But it brings us just good diversification.
Okay, now, excuse me, thank you. Taylor, how are your clients looking at alternatives now? How are you presenting them to them?
We've been presenting the recommended investments, period, as those that have strong demand behind them. I think I like how Melissa put it in her presentation, is the reason to focus on these alternative real estate types is not necessarily for diversification or for other reasons, but rather because they have strong megatrends behind them. And so we've been looking at similar megatrends for the past 10 years and identifying these niche or alternative sectors as those beneficiaries, recognizing fundamentally that the primary risk in real estate is just simply, as one of our clients likes to say, keeping it full. And if you're alongside these if you're investing alongside these long-term demand trends, you'll keep your buildings full. That covers up a lot of other problems and mistakes that we all inevitably make. And so that has led us to a number of these niche sectors over time. Senior housing, student housing over the past decade, self-storage, medical office, single-family rental, and others that we've tried to identify funds, vehicles, partnerships for our clients, but haven't yet got there, which I think is one of the challenges with the sector is how do you invest in it? Are there partners that are sufficiently institutional, quote unquote, at this point for allocations from large institutional investors? I suspect over the next decade, based upon the trends that Melissa was describing, we'll see that. I think if this space was fully developed, we'd see even more investing at this point in niche sectors. So that'll be an interesting trend to watch over the next decade.
Well, based on what Melissa presented, do you see bringing your clients to a 50% allocation in alternatives over the next decade?
I haven't done the count, but I would say that some of our clients, depending on how you count alternatives, are pretty close to being there already.
Okay. So, Melissa brought up something, and you also brought up something about the past 10 years. And we're also supposed to be looking at the next 5 to 10 years. 10 years ago, we were in the midst and probably coming out of the global financial crisis. 10 years from now, we'll probably be coming out, hopefully, out of the COVID-19 crisis. And in 10 years, probably some of the millennials will be having grandchildren at that point. But something unbeknownst and unthought of at this point is that most first graders and second graders who started their entire curriculum online will, in fact, be graduating as well and joining the workforce. So how does that move into your assessment? I'd like that to the entire panel, Melissa, Michael, Taylor, and Manny. How do you view the next 10 years? It's basically hard to focus on the next 10 minutes. So how do you look at the next 10 years?
Yeah, I think there's things you can, it's a great question, right? There's things we can control or look ahead and project over the 10 years, and there's things that are just unknown, right? When you think about aging demographics of like the baby boomers, right? They're hitting an age where, we're starting to see almost that peak period of demand for senior housing, right? Regardless of GDP, regardless of some of these things, you have an aging demographic, right? Melissa alluded to single family rentals, right? That driving force behind apartments wants 3 bedrooms, wants a yard. The amenities homes have, right, that apartments can't offer, but they necessarily can't come up with a down payment to buy a home. They don't want to make the financial commitment that comes with a 30-year mortgage today. So I think some of those demand drivers, regardless of where GDP is, regardless of who's president, right, you're having these age demographics play out. And I think those thematics, and listen, there's going to be opportunities in almost every sector. There's smart ways to make money today in retail, in any sector, right? But I think when you follow tailwinds and thematics, I think that, you can get behind certain themes of aging population. There's things like data, right? Look how we're doing this over the web right now. I think everybody realizes how important that is, regardless of some of these changes. And I think if you could find interesting ways to take advantage of that in real estate, right? That's our business, servicing demand, right? Finding interesting ways in these fragmented sectors to create value, rolling up your sleeves and kind of being there to kind of take advantage of where it goes. I think you have to be nimble, right? I think these sectors that we're focused on today at Nuveen, I think are going to be changed in 5 years, right? I think we like the big thematics, but the way we do it is very niche. And I think you have to be able to pivot when COVID and things happen, right? There's certain sectors like senior housing and self-storage that we didn't really love pre-COVID, right? But those sectors in particular that we think got a lot more interesting in a post-COVID world, along with hospitality. So I think you have your big thematics, but from my perspective, you have to be ready to pivot at any time.
Okay, thank you. So Melissa, Taylor brought up a good point. How do you define alternatives? 20 years ago, multifamily wasn't even considered an investment class in real estate institutional investing. What do you see? What do you see out there that could be considered interesting or creative that could end up being within the alternative real estate class?
Yeah, thanks. This is a good question, right? There's a whole bunch of frontier alts. I think Michael sort of alluded to it. I do think COVID in the next 10 years probably brings new quote unquote frontier alts that we just don't know about yet. I'd say right on the frontier today, things like ghost kitchens, right? So that's definitely ramped up. That was there pre-COVID. It's definitely ramped up post-COVID. Ghost kitchens, where it's just a bunch of restaurants together. There's no seating or dining area or anything like that, and it's all just delivery. So stuff like that's really interesting as a sort of frontier alt. And I would bet, you know, and it's our job, right, is to sort of stay on top of what is like the next, you know, new thing. Cause I don't know. I just don't know. But that's sort of the fun part of the job, I think. So it'll come.
Yeah, just to jump in really quickly, we love as a team looking for those new concepts. The ghost kitchen idea, vertical farms, that you kind of go through the list, and it, you know, it's really interesting. The challenge for, and you know, Manny can of course weigh in on this. The challenge for large institutional investors is scale for those types of opportunities. You know, how do you really move the needle in a multi-billion-dollar real estate portfolio in a lot of these niche sectors? And I think that's something that we continually wrestle with. We might see something that's an opportunity largely because there's so much demand for it relative to the scale, but the scale is so small when it comes down to it. And I think even some of those that Melissa mentioned in the presentation may not have the scale sufficiently for that many investors to really move the needle in their portfolios. And so that's what we're really looking for. You know, what's alternative, what has good demand behind it, but what's big enough to really move the needle.
So thank you. So Manny, let's get back to you since Taylor brought this up. How do you present a creative niche idea within the committee? I mean, someone comes to you and says, I have this great vertical farming idea. I mean, the whole nature of what you do is conservative investing, but still presenting that growth. How do you balance these issues?
Yeah, you know, Taylor hit the nail on the head. It always comes with scale, right? If we can't do scale, it's really hard for us to get really comfortable. But, you know, the one thing that we have the benefit of is that we have an emerging manager program. So we, you know, which focuses on smaller managers, smaller bite sizes. And I'll tell you, we've been able to see some opportunities. We actually are invested in a RV storage fund, right? It's small, but it's a niche, something that we can monitor for many years to come. You know, we've done a lot of self-storage, so it's you know, kind of complementary. You think the CapEx in self-storage is low, you know, for RV storage it's that much lower. So we like the fact that we have this program that lets us invest with smaller managers and kind of, you know, play it out, see what happens, you know, see how it evolves. So that's a good opportunity for us. You know,
okay, no, thank you. With that, actually, let's get into the risk profile. Taylor and Michael, how do you see, what are the biggest risks in investing in alts?
I'm having a trouble answering that question directly because I think it's specific to each alt. So I'd say that probably the general answer, just going back to my previous comment, is scale. You know, are you in which ties to similar issues such as liquidity and so on. However, as I say that, I recognize that one of the things we haven't touched on is the fact that the alts are so much more represented in public real estate relative to private real estate at this point, that there actually is a lot of liquidity. They're just not necessarily represented in the most customary benchmark for a lot of institutional investors. But I think each of them has their own set of risks. So if you look at single family rental, for example, one of the risks that we perceive is not necessarily a risk once you own it, but if you're planning to invest in it, is a supply risk. You know, are you really going to be able to find land and compete with home builders? That's become a major issue this year as the for sale housing market in suburban locations has boomed, kind of surprising everybody, but has kept build to rent opportunities at bay at this point, because, you know, they just can't compete with the home builders. You look at senior housing, on the other hand, it's a space we really like. Unfortunately, it's a space that municipalities really like too, because there's no negative fiscal impact of a bunch of senior apartments. Essentially, they're not putting demands on schools or the roadway as much. So they love to entitle these things. And so there's always risk of oversupply of senior housing. so the self-storage has similar kind of municipal risks as well. The municipalities love to tax this stuff because they don't love it. So you can be stuck with a huge assessment that can wipe away gains that you may have otherwise realized. So from our perspective, you have to go through property type by property type to really identify those risks.
Michael?
Yeah, well said, Taylor. I'd say you just can't broad brush these alts, right? And you can't even just broad brush medical, right? Taking medical office where we see a lot of opportunity, and we're big believers. I think there's a lot of interesting opportunities. There's really high barriers to entry to get into this space, right? These relationships with the healthcare are paramount. Can't just go establish these relationships overnight. And I think people getting in have to understand their partners and the relationships they have with these healthcare partners. So I think it's very niche, not just to the alts, not just to medical, but really per asset, right? These alternatives, you really have to understand the nuances. They're very local, right? Taylor talked about senior housing, right? I mean, we like senior housing, but we like senior housing development, right? We don't like stabilized senior housing. We think the product we're developing today is very different than the product that's out there. So I think you have to really have a very focused strategy here, right? It's, self-storage. These are all very, very, very micro local strategies. Like what's your 3 to 5 mile radius? Medical too, right? Where's your demographic in that micro market of a suburb? Where are you drawing from? What's the credit of that healthcare system? And you parlay that with $10, $15 million deals, right? Those are gross size of the deals. And it's a lot of work, right? And I think that's where the opportunity is. We see scale's the issue. And I think you see a lot of capital. We've seen asset managers, a lot of more capital playing in these alt sectors than there was even 6 months ago, right? The REITs are very active today as buyers again. But we're seeing most of that capital coming into alternatives on the core side. I think people are coming in, sticking with the MOB theme and saying, you want to know what? This has got 7 years of WALT, long dated WALT. I could own this, limited risk in the near term for me. I can learn as I go on an opportunity. And I think that's kind of where we think the opportunities. I think alt is a really interesting time because Melissa kind of alluded this to in the opening, but I think there's all this core dollars out there. And that's where we see the majority of the capital coming in because they can get dollars out quicker. There's a lot more institutionalized dollars playing there. But these alts broadly are still pretty fragmented, right? So there's a great arbitrage there where I'm not sure too many other sectors where you have core pricing really, really strong, but still a lot of low-hanging fruit. If you're willing to roll up your sleeves and do $5, $10, $15 million deals to sell ultimately to those core dollars, I think that is the opportunity. You just have to be willing to really put in the work, right? Self-storage, knowing your right markets, knowing the assets, knowing what the REITs and the core buyers want, and taking uninstitutional assets, creating a portfolio. There's a real portfolio premium in a lot of these sectors. I mean, single family rentals, medical, self-storage, real portfolio premiums in there if you're willing to aggregate and ultimately sell to that capital that wants these assets.
Thank you for that. So Melissa, I want to get back to you in terms of research and what both Michael and Taylor and Manny have brought up. Now we're talking about alts, but then there's the niche within the alts. How are you finding, we're almost getting micro on the micro. How are you tracking this kind of information, and what kind of returns can they promote? I mean, there's differences in medical office, there's differences in senior housing, there's even differences in industrial. I'd like to hear your impressions of that.
Yeah, I think how it works is it's a really interesting and good question because as a researcher, I'm looking at sort of the macro trends, right? So I can say, okay, more movement to sort of outpatient medical office, obviously the demographic play, whether it be for seniors or single family rentals. And I can probably, as a researcher, maybe get one level down from that, right? And specific into, we like single family rentals in this market or that market. But then where it really works, perfectly is then, in the execution part, right? It could be, I'm not going to be able to get as kind of niche and detailed as Michael will. And so the execution part, what's the mousetrap sort of being built, across these different alternative types. And I think you can kind of marry the two. And once you can marry the two, that's kind of when you really start to, kind of gain some kind of neat momentum in these. And you sort of, it's kind of, it won't always be, sometimes, the macro is like, not, it's too macro, right? Like you got to get more niche. But I would say in general, it works pretty well. The marriage works really nicely. And it also, what's nice about that is it's a way you can communicate to investors like, hey, we don't just randomly buy everything and anything in these sectors, right? We have an actual strategy, whether that be, top down or we married it together. And I think it can work really,
That's
really
good.
well.
So Michael, back to you. How do you execute on these micro strategies?
Yeah, that's a great question, right? I mean, Nuveen, we're one of the largest asset managers in the world in real estate, right? But I mean, our biggest conviction right now is aggregating $5-10 million self-storage deals, building built-to-core for medical office buildings for $15 million deals. And the way we're able to do it and the way we really execute these strategies is leveraging that scale for proprietary pipelines, right? So we have strategic partners that agree with our strategy for execution that we spend a lot of time researching, analyzing, and say, okay, we like self-storage, but we really like our strategy in self-storage, right? Not competing with the REITs in that case, selling to the REITs, secondary markets, proven strategy that we could really execute. And then we can go to our partners, right? I think this is key here, right? I think it's understanding what you can do in-house and what you can't. And I think trusting operators and understanding that side of the business is key for our success. So for us, it's about leveraging our scale for proprietary pipelines with operators, one. And number two, because we can get better economics that way when we can commit the amount of capital we can to the kind of taking out all their pipeline. And the first look, right? That's ultimately how we execute. We're very responsive and quick because we're not going to do every deal. But on these sectors that we have conviction around, we set up strategic partnerships, have a first look. We're not going to do everything like I said, so we're quick. But for us, having proactive partners out there sourcing for us, those aren't go both ways, right? So we're still doing deals with other operators, given how fragmented these sectors are. But the majority of our pipeline really comes from strategic partners that are out there sourcing on our behalf. And if we say no, they're just going to go do it with somebody else. But we think it leads to better execution, better pricing at the end of the day, and better economics for us.
Right. So really, really good. We just got a question in from someone overseas. And the question to all the panelists are, what are your views on international alternatives in terms of sectors and strategies? You know, it's a pretty open-ended question, but it's nice that we got that question right now. I'd love to hear from Taylor, actually. That would be the first place to start.
Yeah, sure. It's a good question, one that we've talked about quite a bit, but we oftentimes refer to kind of the classic corporate strategic dilemma that you face, which is new products and new markets, right? If you're going to expand into something, are you going to expand into a new market or a new product? It's usually dangerous to go into both, right? So, even though I think there are tremendous opportunities for these alternative real estate property types overseas, largely for the same, due to the same drivers that we're experiencing here in the United States, I'd say most investors should be, at least in the United States, for example, should be relatively cautious about making both of those leaps. I guess that's my quick response to that. But it's an area we continue to follow.
So, man, thank you, Taylor. Manny, obviously, New York State has a big allocation. How do you look at the international market in terms of alternatives? Are you there yet?
Yeah, well, so we're definitely there. So our biggest position is self-storage in Europe. So we're an investor in one of the in the largest self-storage owner in Europe. So we've been doing that for the past 15 years. So definitely we like the markets. Everyone's been to Europe. We know how big those apartments are and the availability of space. So it's worked out for us and has good growth potential. But to Taylor's point, you have to you have to understand the property before, when you're going into a new market. That is very key. In regards to, what we would be okay overseas, probably student housing. We've done some debt internationally on that, and the senior housing, right? There are some, if you look at the Nordics, senior is, something they stress a lot, and it's very, there's a good risk return there investing in senior, but you really have to know the market itself. Well, first, you got to know the property type, like Taylor said, but then really understand the market. So the markets are sparty as to where we would go specifically for these niches.
Okay, and I want to bring a question to Michael, which just came over the wire. You know, a lot of alternatives have basically you're buying into operating companies, and does that make you nervous from an exit perspective? I mean, what additional return do you need to be comfortable with taking on an operating risk like that?
Well, that's a great question. I think the operating side that you're speaking of really doesn't sit with the way we invest in the asset, right? It's connected to the asset, but it really sits with our partner in the operators, right? We know what we know, and I said this before, and we know what we don't know in these sectors. So we bring in the operational side as we need. I think that is one of the keys to being successful in alternatives is really understanding your operating partner, how they can execute, how good they can execute, what you can trust them with and what you can't, right? I mean, a lot of our operating partners, we bring a lot to the table, right? We have, being our scale, we could bring in our debt relationships, capital markets, we could leverage things. So it's a very important dynamic from both sides. I think that you just have to go in understanding that you really rely on your operators to really create some of that value and execute the business plan. And I think that it's a really important to understand that. And really, I think there's a lot of capital flowing to these alternatives. I think that there's a lot of operators that kind of shift between these sectors, right? Storage was easy, they got into it. Senior housing, right? We saw, nobody missed the development over the last couple of years of senior housing. We just saw it just balloon. One that I think you have to be really careful with today is life science. Right? I mean, I think the demand's there. We like it. We actually have a pretty good pipeline right now of deals we like, but how many groups do you really trust in executing a life science strategy, right? I think you have to be really careful. There's a lot of groups getting into it, very specific build outs for these tenants, very expensive if you get it wrong. So I think you really have to go understand who you're partnering with in a lot of these sectors, and you can do very well, right? They have a lot of tailwinds, but you really have to understand, and I think going forward, example like life science, medical, like, do they really have the relationships with the healthcare systems or not, right? Do they really understand the tenants and the needs of life science or not? I mean, I can count on one hand the number of partners we would do deals with today in life science. You know, I don't have enough, digits on my hands and toes to say the number of groups that are trying to do deals with us right now in life science. So I think you have to really be careful because life's too short to kind of have to deal with some of these deals that go sideways.
Can I jump in on that really quickly, Jonathan? It gives me the opportunity to get on my soapbox on an issue that I've been feeling quite passionate about lately, which is, first of all, to recognize that there probably is a scale of operational intensity across real estate property types. At the same time, if we're not thinking as investors of office, retail, multifamily, even let's say triple net leased industrial as an operating business, I think we're at risk. It's kind of compounding risk in our portfolios. The traditional property types are operational businesses as well, and that's what's going to drive opportunity and mitigate risk in the future. We have to, the office right now is property type non grata for most investors at this point. Nobody wants to touch it. But the office opportunities that will emerge over the next 10 years will be from managers who are figuring out how to operate them more effectively, convert them, create some kind of diversifying factor that turns what investors and operators had treated as commodity because they didn't operate it effectively into something that tenants actually want to be in. And so I think the managers that will set themselves apart over the next 10 years, talking about 10 years once again, are those that really figure out that they are operators, that each asset is an operating business, and they really get that right. And I think by the end of the 10 years, there will be relatively little difference in terms of operating intensity across real estate property types, because we're just going to have to figure out how to operate these all more effectively in order to generate returns in a low return environment.
Okay, no, that makes a lot of sense. So like that brings us up to another question. I mean, what alts are you worried about right now? What are you bearish on? And at some point, office could be the next alternative if it's going to crater, not crater, but take the dip that you're looking at. Manny, what alts worry you right now?
I think for me, it'd probably just be the obvious, student and senior housing, just because of the near-term pressures and yes, the uncertainty that comes with it. But with that said, I think, there will be opportunities there as, as the future comes out, and, points back to the points that were made earlier in the conversation. It comes down to the demographics for both, for, the students and the seniors, just the aging population, the boomers, right? But depending on what you read, it's going from 44 to 66 million people that are, going to be turning seniors. And I think the U.S. Health and Health Services was noting that 2/3 of them are going to need some sort of long-term care. So, near-term pressure, but over the long term, I think we'll be okay. But, near term, I think that's, what kind of worries me, student housing and senior housing.
So, thank you. So Melissa, what are in the tea leaves that you're reading? What some things seem to be soft in the alternatives market for you right now?
Yeah, I mean, I was not a big fan of student housing pre-COVID, largely because I just thought it was really overpriced, and then you've got this sort of demographic drop off. So if you look at a chart that shows just sort of the amount of children born in the U.S., it like dramatic just drops after 2007, and that has huge implications for student housing. So there's going to be fewer students coming in, just fewer people, right, coming into students. So you've got this really big demographic headwind coming onto student, plus it was just priced super aggressively. Post-COVID, to the extent it reprices, could become a little more interesting. I still don't love it because I do think the demographic headwind is humongous. I think, certainly as Manny pointed out, senior housing has really gotten pretty heavily body slammed. But I still do like, the development aspect, because I think, in our studies, we pulled apart the NICMAP data, and by our estimations, nearly 75% of current senior housing is obsolete. And I actually think it's a real opportunity to develop kind of the next gen, of senior housing in a kind of post-COVID world, taking into account and also what the next gen of baby boomers will actually want.
Okay. No, thank you, Michael. What are you not looking at?
Well, I think we're not looking at a lot of things, right? There's a lot of things that we are not looking at. And I think we've alluded to this a couple times, right? I think, we keep a very, very micro niche focus on these sectors. Big themes that we like right now: SFR, manufactured housing, medical office, self-storage, senior housing. But we like senior housing not from a stabilized, we like senior housing from development. Very nuanced, very specific markets, very specific unit mixes. We like medical office from a build to core strategy. We just don't like broadly marketed deals. All these are very nuanced, right? We like single family rentals from a buy strategy, right? Very specific way, by buying homes off the MLS in very specific markets at very specific price points. So I think you really need blinders to, in a lot of these sectors. I think broad sectors, I think student is one. Melissa may allude to this. I don't think we're backing up the trucks anytime soon to that. I think it's really important to think about pre-COVID, post-COVID. I think hospitality is one that we're probably a little bit more interested in today than we were pre-COVID. I think it's probably a value distress play that we're interested in. Will we do something the next couple of months? Maybe. We're speaking to a lot of groups. If we could find an interesting way over a 5-year hold, maybe we will do that. But I think, that kind of plays into like something we're bearish on, where we almost like it because it's so bearish in a lot of ways, right? So I think pre-COVID, post-COVID, some of these things have changed. And I do think, constant theme you've heard today is there's a lot you've got to really look out for and really do your research before you get in these alternatives. And I think you've seen, I think an important part of that is you've seen great returns from everybody, right? You've seen so much cap rate compression in these sectors. I think it's important to kind of distinguish who's been creating value at the NOI level and how they've actually been performing relative to each other. Because I think that's going to be more important going forward than ever.
So that brings up another good point. Should alternatives come with a risk premium when investing in it? And first of all, how do you present that to an investor or a consultant? And I'd love to hear from the investor and the consultant how that feels when you hear that. So I don't know, Manny, you're on.
Well, I think you should get some sort of premium, but over the years that has just gone away. Just so many people in the sector, right? When we talk about risk, what's a risk? Just so many people looking at the alternative as well, right? So, Michael pointed out, it's just the yield compression that's kind of not kind of, but it's just kind of deteriorated that alpha or that risk premium that we should be getting for it. You just don't see it, right? To Melissa's point, student housing, we've been tracking it for a long time, and it got crazy, how they're trading, hot pancakes. So it's gone, you should, but I don't think you're going to see much of it today, just with so much capital out there and everyone's so much focused on the alternatives today.
I think that's exactly right. I think you generally should, but you're not going to. In some cases, that will be rational. In others, it won't be rational. And just to use those student housing as an example, over the past really, let's say between 2013 and 2018. The spread in cap rates between multifamily and student housing basically evaporated over that time period. And that never was really that logical, given that you have 100% turnover in your property type every year. Even if you're underwriting CapEx effectively, you're probably never getting it exactly right. It is just kind of inherently more risky than market rate multifamily in general. So that should, I think, my opinion, should always have a risk premium associated with it. On the other hand, within the last couple of years, the premium between multifamily and single family rental has totally evaporated. And for a while, and maybe it's even the case in the public markets, the single family rental REITs were trading at lower implied cap rates than the multifamily REITs. That might be entirely logical. If you really believe that there's a significant movement of households for demographic reasons to the suburbs, then there's great underlying demand fundamentals. It's easy to leverage and get very attractive leverage for single family rental portfolios, a lot of liquidity and optionality. So maybe it's entirely appropriate that there is no premium, there'd be no premium for single family rental. That therefore makes it okay, right? If there's no way to justify a premium, then you should buy it at that price, and that's the appropriate risk return framework.
So someone has brought up a question. The issue of public markets did come up, and REITs obviously are more considered public markets. But one of the questions that came up is low beta correlation to U.S. equities market, and that could also mean REITs, the main driver of institutional demand for alt investments over the next decade. Anybody? Michael?
Melissa, you want to lead that one off? I got to start with the research head on that one. She'll get a better answer than
yeah, no problem. I don't know. I guess it would really depend, right, on the investor, and did they have, they have an allocation to REITs and private real estate, if that's how they're looking at it. But I would guess, right, institutional demand for alternative investments in the next decade is purely just, hey, looking across the spectrum, right? Retail and office, don't know, uncertain, out of play. I got apartments and industrial that I can allocate to, and that's like it. Like, what else do I got? So I gotta kind of broaden my horizons there. Is what I would assume is going through the minds of investors.
Yeah, I think it's interesting, right? I think the way, like Taylor alluded to this earlier, I think the way we invest in real estate was a lot different 10 years ago. And I think it's going to be a lot different in 10 years from now. And I think following those demographic tailwinds, I think is important, distinguishing just, we think about it, Melissa's chart showed it just as housing, right? Everybody used to call it their allocation to just apartments. I think you're going to start seeing broader maybe terms here, right? Where you're going to say, okay, well, I'm going to have some to manufactured, I'm going to have some to maybe some to obviously a big selection to apartments, SFR, senior housing. So you're kind of being able to diversify your apartments to more of a broader housing strategy. I think that's where it's going, more thematics. I think that can happen. But I think it's, to Melissa's point, I think it's it's more capital ultimately chasing less sectors, with alts being one of them institutionally over the next couple of years.
Taylor?
Yeah, I think that's right. And the challenge that Melissa described is doubly challenging because we're seeing increased institutional allocations to real estate globally. You know, that's been a long-term trend. We suspect it only continues. And maybe it's one of the other things that COVID has accelerated, as real estate has done pretty well, you know, relatively speaking, in institutional portfolios. At least it's done what it's supposed to do. So what we're going to see is more capital and fewer institutional property types, leading to, you know, capitals like water. It flows, you know, it will constantly flow to where it finds an opportunity, and it'll flow to the niche property types. I think it'll also flow, which could be the topic of another webinar, to other markets as well, both international as well as secondary, tertiary markets, just as it needs a place to go eventually and will seek those returns as well. But I think, you know, the public-private question is an interesting one. I think for any institutional investor interested in the space, you have to, one of the first questions you have to evaluate is, do you want a public execution or a private execution? Michael was describing a reason why you'd go private. You know, you take a little more risk. You think there's some benefit, some arbitrage opportunities to do that and sell into the public. If you're less interested in that, there may be really good reasons to just invest in REITs. It's going to be more liquid, of course. The players, the existing players are more institutional. They have scale. They figured out the business. Some of them are the best in the business at this point. So it's really important question that should be part of any evaluation if an investor is going to go into the space.
You bring up, yeah, Melissa.
It could also just be, you know, I think if you think really, really big picture about it, right, there's fewer companies that have, like The Economist penned this article 5 years ago, fewer companies are IPOing into, like, your ability to invest just in the stock market. It's still there, obviously, it's still there. You can invest in the S&P or Russell 2000 or whatever, but it's less than it used to be. And then that was also at the same time the rise of, you know, private equity, which private equity, whether that be real estate or just private equity overall, kind of starting in the mid 90s, really sort of took off. And so it could just be investors sort of saying, you know, my options, well, not limited in the public market, whether that be corporate bond or equity. There's certainly a huge rise of the private equity investment opportunities in the last 10, 20 years, as more and more companies just say, I don't want to go public. And so that keeps them private, and that expanded that horizon. That could be partly what's at play as well.
So, you know, I want to bring up another topic, and Taylor touched upon it, and then Michael, I want your opinion on this. When we talk about micros, you talk about micro markets. Are we going to get to the point where even markets themselves are alternative investments? You know, when we're talking about the secondary and tertiary markets, it's not so much the property type, but the locale of these property types.
Yeah, I think that's a really interesting topic. I think it's a little bit less relevant for the alternatives, only because these REITs, all these institutional players, you have to all of a sudden get comfortable with Memphis and some of these other markets like Louisville, of owning $20 million medical office building. There was a lot of liquidity for them there, right? I mean, if you're willing to aggregate them, top 50 MSAs, very, very, top 75 MSAs, storage, very liquid. Medical office, very liquid. So it's very niche per strategy, but I would think if you're trying to execute in the alternative sectors, unless you really want to compete with the REITs and you're really targeting very low yielding returns, gateway markets, top 10, 15, 20 MSAs, they are, you know, it's tough slugging in there, right? You're competing with just really, really core dollars. If you're looking to create more value, definitely there's low hanging fruit there, but I think these are very local. So you can go into some of these markets where you have not, like storage, almost all the development you've seen in that sector has all been the top 25 markets, right? If you go to markets 25 through 50, there has not been the same supply coming online. There's just as much liquidity. You can create little portfolios. The REITs want to go there. They're just not going to go there for one-offs. You can create portfolios, and then they're very liquid. So from my perspective, I think you have to go into these to these sectors and really understand that when you're going in, that these are 3 to 5 mile range deals. Medical office 15-minute drive from these centers, and really understanding the local demographics of them, and really understanding that that's really what drives it. Yeah, I mean, I think thematically, being in Sunbelt, Texas, high growth markets, it makes it a lot easier, right? I mean, I think you could understand growth in these markets, but I think you have to go in understanding that you're going to be a little bit more spread out in these markets in the alternative sectors.
Okay, we have another question. What are the panelists' views on social or impact investing? Do you expect institutional investors to increase allocation to this product? Well, I'm going to start with Manny on that one.
It's an easy one for me to answer. By law, we're not allowed to be a social or an impact investor. First and foremost, it's return. It does factor into the investments that we do, but it's not a strategy that we purely focus on. It's just by statute.
Okay, so Taylor, you have a more complicated answer.
Yeah, exactly. Well, I think there clearly is a difference in interest in, let's just say, ESG investing, depending on what state or institution you're from. There are obviously differences in politics and perspectives and priorities. And so that certainly plays itself out across our clients. I'd say nevertheless, 100% of our clients are recognizing that a lot of risks that have typically, maybe traditionally, been brought up by those focused on, let's just say, ESG issues are actual risks to returns and liquidity and so on going forward, climate change being the most obvious one of all. I think in insurance premiums over the past few years, thanks to very large storms, floods that have taken place where they had historically not taken place and so on, have definitely caused investors to focus on that factor to a large degree, because that hits the bottom line. I think investors are also focused on social issues and governance issues in similar ways, because they recognize that and not only could these cause headline risk problems, which everybody wants to avoid, it could actually impact the ability of your product, which is again the fundamental risk, to fill up, to achieve occupancy. And so I think all of these will be identified increasingly and appreciated as risks, and eventually they'll just come out of the ESG framework over time, and just be part of diligence of returns, which, as Manny pointed out, is the primary intent of pretty much every institutional fund.
And Michael, how do you walk that line, producing the returns and also having a social impact strategy?
Yeah, let me just take that first, Melissa. I think, first off, I'm not surprised this topic came up, right? I mean, I think I've had 2 conversations in the last week with different investment banks that they said this is the #1 topic that they're hearing from asset managers about trying to understand and build out. I think you're going to hear more about it. I think it's driven by capital coming into it, right? But I also think there's just a lot of opportunity, right? I think that there's a lot. Taylor mentioned it, but I think where it goes, I think you're going to hear more and more about this, and I think it's going to be more and more in front of everybody's radar, and more opportunities are going to be out there. I mean, from our perspective, I think Taylor hit it right on. I mean, there's a lot of this stuff that we're talking about really makes sense from an asset level and from a liquidity perspective and a return perspective. A lot of these things that we integrate into our assets, broader real estate, right? It really makes a lot of sense to invest in green energy. You're just helping your bottom line on your deals, right? I mean, a lot of these things about sustainability that are really important really drive the bottom line, which, we all want to do the right thing, but it makes it easier when in the bottom line, it drives performance as well. So I think we're in a sector where we're really aligned from kind of a performance perspective and from an ESG perspective in a lot of ways.
Melissa, how do you track that part in terms of returns on those that have a social impact strategy versus those that don't?
Yeah, I think it's a good question. I think you have to kind of start tracking it now, because I don't know that historically you kind of go back and figure it out. But I do think, at least at Nuveen, we've tried to put into our investment process, the sustainability, we have a fully built out sustainability team. They've put into the investment process very much, is this climate risk? What is the social impact? So, before a deal is even kind of allocated, right, it's very clear, is this deal kind of have some red flags associated with it from whether that be an environmental, social, or governance perspective. So it's definitely at the top of our radar. But yeah, I mean, I think in general, if I thought about it, 2 deals, medical office, one was, behavioral health versus sort of, orthopedic, and it was the same risk adjusted return, I would probably, think about the behavioral health, more favorably than I would, right, than the shoulder surgery. But yeah, it is something that's very much a focus of ours at Nuveen.
So we are going to be wrapping up in about 2 or 3 minutes, and I'd just like to get some final words from everybody on what you think the future of alts will be, because we started with the question over the next 5 years, and I'd like to start with Taylor.
Yeah, sure. I really like Melissa's multicolored windmill chart. That shows what an institutional portfolio looks like in the future. That shows lower allocations to what have traditionally been viewed as traditional real estate investments, and higher allocations to others. I suspect we'll see more diversification by market going forward as well. Really, just as real estate continues its evolution toward real estate in many contexts is considered an alternative investment strategy as well, and I think it continues to evolve as a more institutional property type going forward.
Thank you, Taylor. Manny.
No, I agree. It's going to continue to grow, right? And pointing back to Taylor and Melissa in that chart, at some point, just like apartments, it's going to have its own breakout in the Odyssey benchmark. It's only a matter of time. Maybe not in the next few years, but you could definitely see medical office student housing having its own breakout. And like I pointed out earlier, it's a diversifier for us, and we're going to continue, to look at it. We debate some of these strategies, and but we sprinkle some money here and there to learn a little bit, as and grow it and potentially have more conviction to go into these strategies. But I think it's going to continue to grow, and there'll be more money into it.
That's great. Michael?
Yeah, I mean, I agree with both Manny and Taylor. I think you're going to continue to see more dollars come into these sectors. We're seeing it now. I mean, we've continued to see it just over the last 18 months, more and more deals. I mean, more capital into real estate, more real estate into more of that real estate dollars going to less sectors. And I think you're going to keep seeing that playing out. And I think alts is going to be one of the beneficiaries of that. I think people just have to understand scale. I did say this earlier, and I think it's an interesting time because, the idea of alts is there's still so much opportunity. They're still so fragmented. Healthcare is 1/5 of the US's GDP and growing, right? It's so fragmented. There's so much opportunity out there, and there's so many people that want that core allocation. So I think continuing to find interesting ways to kind of aggregate portfolios, there's going to be tremendous opportunity. We're big believers seeing a lot of deals on the value add side. I think that's going to continue as there's more dollars come in and want access to these opportunities. It's key. I think that's where it's going to start, and I do think it's just going to keep continuing in around the big thematics of healthcare, housing away from apartments. Not that apartments going away, but just diversifying it more across. And I think investors are just starting to kind of tap into that, right? And I think the more they do, the more they're going to want specific strategies around these sectors.
Thank you, Michael. Finally, Melissa, we began with you. We're going to finish with you. Final words.
Yeah, I mean, listen, it's been my conviction for at least 2 to 3 years now that alternatives will play a really large role. 50%, maybe that's too large, but a really large role in institutional investors' real estate portfolios in the coming decade.
That's great. Well, I want to thank our panelists, Manny, Taylor, Melissa, and Michael, for joining us today, and our audience as well. Thank you for your terrific questions, and thank you to our friends at Nuveen for helping underwrite this webinar. Have a great afternoon. Take care.
Thank you.
Thank you.